Welcome back, traders. Now that you've learned key candlestick patterns, it's time to step back and look at the market's overall direction. Candlestick patterns highlight short-term movement, but trends reveal whether the market is climbing, falling, or transitioning. Mastering trends helps you trade smarter, with structure and context. Let's dive in. You may already know this, but it's important to make it clear. A trend is the overall direction the market is moving. When the market is in an uptrend, prices are generally rising. When the market is in a downtrend, prices are generally falling. Recognizing the trend gives us context. It helps us align our trades with the market's direction instead of fighting against it. When we trade with the trend, we reduce unnecessary risk and improve consistency. The goal is not to predict every move, but to position ourselves on the right side of momentum. There's a well-known saying in trading, "The trend is your friend." That phrase exists for a reason. Markets tend to continue in the same direction longer than most traders expect. When we respect the trend, we stop forcing trades and start working with momentum instead of against it. In an uptrend, price moves higher over time. You'll see this on the chart as a series of higher highs and higher lows. Each new peak is higher than the one before it, and each pullback stays above the previous low. This structure tells us that buyers are in control. Even when price pulls back, sellers are unable to push the market lower. Buyers step in and continue driving price upward. In an uptrend, traders focus on buying opportunities. Instead of chasing price at the top, we look to enter during pullbacks and ride the trend as it continues higher. In an uptrend, it's also important to watch swing highs. A swing high forms when price reaches a peak and then pulls back. It marks a temporary pause where buying pressure slows and sellers briefly step in before the trend continues. In a healthy uptrend, each new swing high is usually higher than the previous one. This tells us that buyers are still strong and willing to push price to new levels. Tracking swing highs helps traders make better decisions. They can be used to plan potential exits, manage risk, or identify when momentum may be starting to weaken. We're not guessing tops, we're reading structure. When the trend is moving upward, traders use trend-following strategies to take advantage of that continued rise. Instead of trying to predict tops, the focus is on participating in the direction the market is already moving. Most traders look to buy during pullbacks rather than at highs. Tools like moving averages can help confirm that the trend is still intact and pointing upward. To protect profits, traders often use trailing stop losses. As price moves higher, the stop is adjusted upward as well. This allows traders to stay in the trade while the trend continues and exit only when there are clear signs that the trend may be reversing. In a downtrend, price moves lower over time. On the chart, this appears as a series of lower highs and lower lows. Each time price attempts to rally, it fails to reach the previous high and then turns back downward. This structure tells us that sellers are in control. Buyers are unable to push price higher, and selling pressure continues to drive the market lower. In a downtrend, traders focus on selling opportunities. Rather than chasing price at the bottom, they often wait for small rallies and then look to enter in the direction of the downward momentum. In a downtrend, we also pay close attention to swing lows. A swing low forms when price drops to a low point and then starts moving back up. It marks a temporary pause before sellers step back in. In a strong downtrend, each new swing low is usually lower than the previous one. This confirms that sellers remain in control and continue pushing price downward over time. Identifying swing lows helps traders make better decisions. These levels can be used to plan entries after small rallies, manage risk, or recognize when the trend may be losing strength and a possible reversal is beginning to form. In a downtrend, traders use trend-following strategies to benefit from falling prices. Instead of trying to predict the bottom, the focus is on staying aligned with the downward direction of the market. Traders typically look to sell during small rallies rather than selling at the lows. Tools like moving averages can help confirm that the downtrend is still intact and that sellers remain in control. To manage risk and protect profits, traders often use trailing stop losses. These stops are adjusted lower as price continues to fall, usually placed above recent swing highs. This allows traders to stay in the trade while the downtrend continues and exit when there are clear signs that the trend may be reversing. Take a moment to study both charts. Focus on the patterns of highs and lows in each one. Remember, an uptrend forms higher highs and higher lows, while a downtrend forms lower highs and lower lows. Based on what you see, which option is correct? Is it A, chart 2 is an uptrend and chart 1 is a downtrend? Or B, chart 1 is an uptrend and chart 2 is a downtrend? Make your selection before moving on. The correct answer is B. Chart 1 is an uptrend. Chart 2 is a downtrend. If you got this one correct, well done. You correctly identified the trend based on how the highs and lows are progressing. Spotting trends like this is a key part of understanding market momentum. Spotting whether the market is bullish or bearish can seem easy, but predicting what happens next is where trading gets challenging. Markets don't move in straight lines, so instead of guessing the future, we focus on structure. Reading how highs and lows form helps us understand momentum without prediction. Market prices don't move randomly. They reflect the decisions of countless traders reacting to emotions, expectations, and news. Behind every price shift is a battle between supply and demand, driven by human psychology. When we spot these patterns, we're not predicting the future. We're reading behavior. Understanding psychology helps us anticipate what may happen next, because markets move based on how people think, react, and respond under pressure. Imagine a stock trading at $100. After disappointing earnings news, the price drops to 90. Traders begin to fear further losses and rush to sell their positions. That wave of selling increases pressure on the price, pushing it lower, to 85, then to 80. This isn't random movement. It's fear spreading through the market. As more traders react emotionally, selling accelerates, and a bearish trend begins to form. The trend is not caused by the news alone, but by how traders collectively respond to it. Now consider the opposite scenario. A stock moves from $50 to $65 after news of a breakthrough product. Traders see opportunity and begin to anticipate easy profits. That optimism fuels buying. As demand increases, price continues higher, moving from 65 to 70, then to 75. This upward movement isn't accidental. An uptrend forms because traders are reacting emotionally to perceived opportunity. Increased demand, driven by optimism and expectation, pushes price higher over time. Trends are usually supported by volume. Volume reflects commitment. When price moves higher on strong volume, it shows buyer confidence and broad participation. For example, if a stock rises from $100 to $120 on increasing volume, that move is being confirmed by conviction. Buyers believe in the move and are willing to act. But if price rises from $120 to $125 on low volume, the psychology changes. Fewer traders are participating. Momentum may be weakening, and that lack of commitment can signal a possible reversal ahead. Now let's look at a stock that has been climbing steadily, moving from $200 to $220, then to $240. Each of these moves is supported by strong trading volume, showing confidence and broad participation from buyers. But then something changes. As the price approaches $245, volume begins to drop noticeably. The price struggles to push higher. This shift matters psychologically. Buyers are no longer showing the same conviction, and fewer traders are willing to commit at higher prices. When price continues upward but participation fades, momentum can begin to weaken. This signals that buying interest may be fading. Without enough buyers to sustain momentum, some traders begin locking in profits. As profit-taking increases, selling pressure can build. When that happens, the uptrend may start to weaken, or, in some cases, reverse entirely. No trend continues endlessly. Even the strongest trends experience pauses or temporary shifts as traders react, hesitate, or take profits. These pauses are called pullbacks. A pullback is a short-term move against the main trend. It reflects a brief change in trader behavior, not a full reversal, while the market reassesses direction. For example, imagine a stock rising steadily from $20 to $40. As price moves higher, some traders decide to close their positions to secure profits. That profit-taking temporarily pushes the price down to $35, creating a pullback. This move reflects a short-term shift in trader behavior, not a full change in direction. If buying interest returns, the stock may resume its upward momentum and continue following the larger trend. Pullbacks happen in downtrends as well. Imagine a stock falling steadily from $80 to $60. After that drop, some traders view the lower price as an opportunity and begin buying. That brief buying pushes the price up to $65, creating a temporary bounce. Psychologically, this reflects short-term optimism or bargain hunting, not a change in control. If selling pressure remains strong, sellers step back in and the price resumes its downward move, continuing lower to $55. The overall downtrend remains intact. Here's a quiz question. You're analyzing stock ABC. The price steadily climbed from $150 to $165, then to $172. Recently, it pulled back to $168 and has struggled to break above $172 for several sessions. Study the chart and consider what a trader should do next. Based on what you see, what's the most appropriate response? Is it A, watch and wait? B, ignore short-term moves? C, buy now? Or D, prepare to sell? You have 10 seconds to record your answer. The correct answer is A, watch and wait. The price is testing a resistance level. Waiting for a clear breakout or breakdown reduces the risk of acting on indecision. This approach keeps emotions in check and allows the market to confirm its next move before committing. A pullback is a small pause before a trend resumes. It reflects temporary hesitation or profit-taking, not a change in control. A reversal is different. A reversal flips the entire trend. It occurs when market psychology shifts and control changes, turning an uptrend into a downtrend or a downtrend into an uptrend. Understanding the difference helps us avoid reacting emotionally to normal pauses and recognize when behavior in the market has truly changed. The patterns you've already learned, like engulfing candles, doji, hammers, and shooting stars, often act as early warnings of reversals. They reflect hesitation, exhaustion, or a shift in control before the trend fully changes. When you spot these signals early, you're not predicting, you're responding to changing behavior. That readiness allows you to adjust before the market makes its next major move. Lesson complete. You can now confidently identify uptrends, downtrends, and reversals, key skills for making smart trading decisions. You've seen how price structure reflects trader psychology and how momentum changes as behavior shifts. Next, we'll explore how to identify key price levels. These levels help you understand where price may bounce, reverse, or break through. Knowing them adds context and confidence to every decision you make. Let's keep going. Strong work. We've now completed Day 14, Lesson 1. Solid progress. Your skill set is leveling up. Up next, we'll focus on how to spot support and resistance zones. Keep growing and keep building the mindset of a confident trader. One step at a time, one lesson at a time.
Ready for more? Get the full 30-day trading psychology course at join-mmu.com or join the Inner Circle for free early access to new lessons at mmufreeguide.com. Keep practicing with purpose and performing with precision.